In this video, we talk about the new stress test rates in Canada just announced. Stay tuned. What's up, everybody? It's Rob Campbell, the mortgage broker. If you're new to this channel, please consider subscribing and clicking that little notification bell. You will get notified whenever we upload useful content. And if you find this video useful, please consider smashing that like button. It will help us with our YouTube algorithm goodness and help us get this video out to more viewers. Well, this week it was announced again by the Office of the Superintendent of Financial Institutions, or OSFI for short, that indeed the stress test qualifying rate here in Canada will increase to 5.25%. Now, I did do a video on this previously about what those rules mean for uninsured mortgages and what exactly an uninsured mortgage is. You can go ahead and click up here right now to get that link for the previous video where I go into depth of what an uninsured mortgage is exactly. So this video is just going to be a refresher on the uninsured mortgage stress test rate, but also now news coming out from the Department of Finance this week regarding high ratio mortgages or insured mortgages. And those would be mortgages on purchases with less than 20% down. So again, to recap, this week, OSFI announced that they were in fact going to be rolling out the June 1st, 2021 stress test rate increase to 5.25%. Now, it's not always going to be 5.25%. It is a greater of either 5.25% or 2% or 200 basis points higher than your contract rate. So what does exactly that mean? Well, let's define what that rule means. If you get a mortgage contract rate of 2.29% for maybe your purchase, you've decided to go with a 5-year fixed mortgage and you're getting 2.29% on your mortgage. Well, 2% higher than that is only 4.29%, which means that you would still have to qualify at the 5.25% or the stress test rate. Now, that doesn't mean your payments are going to be based off of the 5.25% rate. It just means that that is the threshold, the benchmark, if you will, for qualifying and be able to debt service the mortgage under the current and newer guidelines of that stress test coming into play. So some interesting news coming out this week about what this news means for buyers and affordability. Well, again, in that link up above for my previous video on uninsured mortgages, but now these rule changes also including insured mortgages or less than 20% down. What this means is, in general, a decrease in buying power of around 4 to 5%. And why do I say around 4 to 5% and I'm not more concrete about that? Well, to be honest with you, when I put a concrete number in there, I always get lit up in the comments about your calculations are incorrect. Well, I've been doing this for 11, almost 12 years now. I can dive into the ifs, ands, or buts of all these calculations. We'll just say, as a ballpark, your affordability will be reduced approximately 4 to 5% on your purchase price power moving forward with these new stress test rates. So a little to talk about today about what an insured mortgage is, because in my previous video, like I said, I talked about what an uninsured mortgage is. So an insured mortgage in Canada is something that I want to cover now. So an insured mortgage here in Canada primarily pertains to a principal residence and meeting CMHC guidelines, or the other two insurers here in Canada. We have Sagen and we have Canada Guarantee. But CMHC is the more well-known entity in the default insurance world because they set mandates, generally speaking, have set the mandates on the the high ratio premiums and guidelines to adhere to. So an insured mortgage in Canada is one of these following things. One, less than 20% down. So if you're buying a primary residence property, you have to be buying with less than 20% down for it to be an insured mortgage. And what does default insurance mean? Well, it means you have to adhere to the guidelines set out by CMHC, and you have to follow these guidelines when qualifying for a mortgage. So that has to do with minimum credit scores, that has to do with the source of your down payment, that has to do with your GDS and TDS guidelines, your gross debt service and total debt service guidelines, being within that 39 and 44 range that we hear so often about in insured mortgages. So it has to be a primary residence or a secondary residence. I'm not sure if many of the viewers know this, but in Canada, you can buy another property with minimum down payment other than your owner-occupied property if it is for an immediate family member. So maybe you've got kids that are going to university, and instead of spending $800 or $1,000 a month on rent, maybe you want to buy a property for them to live in that university city. Or you're buying a home for somebody in your family who's immediate family, and maybe if they've got a disability, or maybe it's your elderly folks that you're buying a home for, and there's some sort of arrangement there where you can't qualify that purchase using rental income. But there's a couple of scenarios there for you anyway. So anything less than 20% down, that's owner-occupied or a second home for you. It just can't be an investment property or a rental property. Another thing that makes it a insured guideline mortgage is that it cannot exceed 25-year amortization. So any mortgage in Canada that's an insured mortgage cannot have a higher amortization than 25 years. It has to be 25 years or less for that amortization, and it has to qualify on that as such. So if you wanted to get a 15-year amortization mortgage with a 10 or 5% down payment, you'd have to qualify for that 15-year amortization at the time of initiation of that mortgage application. Again, just to recap, no refinances can qualify for insurance in Canada. You cannot do a refinance on your current property and have it insured. It's strictly purchases and transfers. Let's say, speaking about transfers, if you had previously bought a minimum down payment home that was insured, so 5 or 10 or 15% down or somewhere in that area, and now you're up for maturity and you want to take that mortgage and move it to the next lender, you can do that as long as you adhere to the insurer guidelines. And those guidelines are something that myself or another mortgage broker can talk to you about in more depth. So again, these rule changes are strictly pertaining, previous video talking about uninsured mortgages, but the Ministry of Finance, or the Department of Finance, has announced that these rule changes will also pertain to high ratio mortgages and insured mortgages. So just to recap, after June 1st and moving forward until further notice, every mortgage that qualifies has to qualify on 5.25% or higher, depending on the contract rate that you're getting. So again, if you're getting a mortgage that's 4.5%, you have to qualify on 6.5% because it's 2% higher. It has to be the greater of the two. Okay, so a lot of confusion about this news, a lot of confusion about when it's going to be implemented. It's going to be effective June the 1st. So another question is, what do I do if I already have an approval that's been given to me by my broker or bank, but I'm closing my purchase on June the 15th? Do I have to requalify? No, you don't. This rule is taking effect as of June 1st, but any underwritten and approved files previous to June 1st, 2021 will be grandfathered in to the older rule. So you don't have to requalify if you have a live deal in your hand. So you've got an accepted offer or a signed commitment that's not going to expire. So some news out of Ottawa this week, just before the long weekend here, pertaining to high ratio insured mortgages requiring a higher stress test as well. Just be cautious when using online mortgage calculators. Some online mortgage calculators allow you to have that new stress test already implemented into the calculations, but just be cautious with some calculators that you might find online. They might be giving you a false sense of hope because they might be qualifying you on the actual contract rate and not the stress test rate. So a little air of caution there. I'm going to try to drop some links down in the section below, the details below this video, and in one of those I'm going to put in a link to the press release by the Department of Finance, and also give us your comments. I'd love to see your comments. I love reading the comments. Drop your comments below. Are you in the market to buy a home this year? Do you think these stress test rates are going to affect you and your families for affordability? I know a 4 to 5% decrease in purchasing power can certainly make or break some situations for people. Are you in the market to buy this year? Do you find this housing market crazy. I know a lot of people have. I know a lot of you have, and we've had that dialogue before. So anyway, a little bit of news today. Like I said, on insured mortgages and uninsured mortgages, stress test increase goes to 525. It's the greater of 525 or 2% higher than your contract rate. So just be careful of that. If there's any confusion about any of that stuff, link us up below or reach out at any time, and we're always here to help. Again, I'm Rob Campbell. I'm a mortgage broker here in Canada. I'd really love it if you smash that likes button on this video, and also consider subscribing and to this channel and clicking that little notification bell down below so you get notified every time we put out great content. Have a good day. Have a good weekend, a long weekend here in Ontario, May 2-4 weekend. And thank you for watching this video. I really appreciate it. Take care, everybody. Bye-bye.